Alright guys, and here on our news it says top analyst says it's all over. XRP is going to zero. So the question is this viral chart proof that XRP is completely done for? Right? We are looking at something that absolutely set the crypto internet on fire over the last 48 hours. If you have been scrolling through X, you might have seen a post from a very prominent market analyst named ChartNerd right here that made a lot of people drop their coffee. The caption was terrifyingly simple. It said, "It's all over. XRP is going to zero." And he attached a technical chart that looked like an absolute disaster for our favorite token. Naturally, panicky retail traders started hitting the sell button without actually looking at the data. But if you take a closer look at what is actually happening under the hood, you will realize this is one of the most brilliant pieces of psychological misdirection we have ever seen in this market. The chart isn't predicting a collapse at all. In fact, it's doing the exact opposite. Right? Now, what is the psychological trick hidden inside the price scale? When you first glance the data chart nerd shared right here, you see the price action struggling against a brutal overhead boundary before pointing straight off a cliff. It looks like a classic distribution phase where the asset simply runs out of buyers and plummets to a value of zero. But here is the catch. The price scale on the right side of this screen was completely flipped upside down. I repeat, it is completely flipped upside down. When you invert a financial chart, what looks like a terrifying drop to absolute zero is actually a massive parabolic breakout to the upside. The analysts deliberately used this optical illusion to catch the attention of algorithms and emotional traders who only react to negative headlines. Now, here's my opinion. I absolutely love when analysts do this. The crypto space is so filled with noise and mindless hype that sometimes you have to shock people to get them to actually study the structural data. So to me, this flip chart shows exactly how easily the masses can be manipulated by a single bearish headline, even when the underlying metrics are screaming that a multi-year accumulation phase is wrapping up. It proves that smart money thrives on creating panic before a major liquidity rotation. Now, how does the 2017 macro pattern fit into the current market? Once you unflip the chart and view it normally, the structural comparison becomes crystal clear. The data pits our current multi-year price action directly against the legendary consolidation block that occurred between 2014 and 2017. Back then, the asset spent years grinding beneath a heavy macro descending trend line, experiencing distinct painful rejections every time it tried to break free. Specifically, the historical data highlights 4 clean tests of a foundational rising support floor. Every single time the price hit that line, the weak hands gave up, thinking the asset was dead. But on that 4th concluding test, the selling pressure completely evaporated, acting like a structural launch pad that triggered a historic run. So fast forward to July 2026, this month and year, the chart reveals we have now successfully completed 3 macro tests, that exact same structural floor since the year 2020. Now here's my opinion. My perspective is that history doesn't always repeat it perfectly, but it definitely rhymes. We are currently creeping toward that definitive fourth macro retest. So in my view, this isn't a sign of weakness. It's a sign of a market that is thoroughly squeezing out speculation. The retail crowd gets bored of assets that take years to build a floor. But this slow cook accumulation is precisely what builds a market structure strong enough to sustain real institutional value. Now, what happens when the white and green arrows align? To make sure nobody actually went out and sold their bags in a panic, the analysts draw up a follow-up chart that zooms straight into the recent monthly candles. This secondary view removes the inverted scale and lays out a very clear long-term trajectory. It maps out a distinct white arrow showing the asset drifting directly into the apex of this macro wedge. Right? Once the price interfaces with that foundational support line, the model projects an explosive structural breakout. From there, a massive green arrow extends all the way up to a target value of $27. However, this isn't a get-rich-quick scheme. The analyst explicitly places the arrival of that $27 valuation near the 2030 horizon, indicating a steady macroeconomic advance rather than a random 24-hour pump. Now, here's my opinion. Too many people in crypto promise that your favorite coin will hit double digits by next Tuesday. So, what I can say is that a target value of $27 makes complete sense when you factor in the multi-year tokenization of real-world assets and global banking corridors that are being built right now this year of 2026. This is a long-term infrastructure play. If you are looking for a quick casino trade, this isn't it. But if you understand macro market cycles, a target of $27 by 2030 is highly logical based on historical capital rotation. Now, can the final resistance boundary be overcome? The ultimate hurdle for this entire thesis remains the heavy macro resistance line that has kept the price suppressed for years. Every time the asset attempts to break out, it gets heavily rejected, creating a long trail of red candles. Now, my take on this constant rejection is that it acts like a giant filter. It filters out the impatient money, where the more times a major resistance line is tested, the weaker it actually becomes because the selling orders sitting at that level gradually get filled and cleared out. So, I'm watching the volume profiles very closely during this approach. When that final boundary eventually breaks, there won't be any sell orders left to stop the momentum, which explains why the subsequent projected move is so aggressive. Now, what is the definitive takeaway from this flip chart drama? Ultimately, the lesson here is that it is all about perspective. A headline can tell you an asset is going to absolute zero, while the actual data points to a historic double-digit breakout. Now, here's my opinion. We are entering a phase of the market where patience is the ultimate edge. The charts are showing a beautifully mature long-term accumulation structure that mirrors the greatest bull run in digital asset history. So don't let clever headlines or inverted charts shake you out of a position that has taken over six years to build. Look at the past, look past the psychological traps, study the macro floors, and keep your eyes on the long-term utility. And finally, here's our overall conclusion. XRP is definitely not going to zero. The viral post was a masterclass in catching attention through visual inversion. When you look at the true structural data, the asset is methodically tracking a historical macro pattern that completely reshapes the global liquidity narrative. With 3 solid tests of long-term support already locked in, the market is slowly but surely positioning itself for a definitive structural breakout. While the projected journey to a value of $27 is mapped out as a multi-year climb leading into 2023, the foundation being laid right now is incredibly robust. So stay disciplined, don't react to emotional traps, and always remember to unflip the chart before you make a move. So keep those hands diamond, and I'll see you in the next update. Or you might just as well check this next recommended video right here.